my name is NORATIEKA binti AHMAD. Today I will present our slide on global investment decline may worsen due to tariff. For the introduction, foreign direct investment or FDI is important because it helps countries grow their economy, create jobs, improve infrastructure and develop new technology. However, rising tariff, geopolitical tension and policy uncertainty have reduced investor confidence and slowed global investment. According to UNCTAD 2025, global productive FDI declined by 11% in 2024, although North America and Southeast Asia still recorded the same growth. And in this slide, we will explain the causes of the decline, its impact on the economy, and the possible solution. Now, let's move on to the background of the issue.
Assalamualaikum. My name is SHAHIDA AZMI. I am presenting part of background, issue and critical analysis. So what is basic of the FDI? FDI is the foreign direct investment when a company invests in a business abroad to gain significant control of it. And the good FDI boosts global growth, share technologies, create jobs and improve international trade. So what government usually do is government usually try to attract FDI using tax incentive, good infrastructure and business-friendly laws. So the current decline, which is in this article, is global investor confidence is down, causing cross-border investment to slow significantly. So what is causes? This drop is driven by poor economic conduction, political instability, and unpredictable regulations. So what is the impact? If this continue, it will slow down global economic recovery, causes the widespread job losses, and make it harder to hit global development goals. So this article overview is about the report from Reuters and UNCTAD shows that the investment decline will get worse due to rising tariff, which is the import taxes and trade fight between major countries. Governments are turning inward, putting up barriers like higher taxes and strict rules on foreign money. So there are three step change reaction, which is the first is high cost, protectionist rules increase the expenses of companies. Second one is the less trade, international trade slow down as a result. And the third one is a frozen project, which is the multinational stop investing long term, putting global project on hold and or cancelling them. So what is UNCTAD warning? The future foreign investment look grim due to political tension and slow economic growth. So what is warned that unless countries remove the trade barriers and bring back stability, the global investment will keep dropping, harming both rich and developed nations alike. Hi. Next, we move to the global investment decline. This is the main issue for this article. So there is an ongoing decline in global foreign direct investment (FDI) driven by rising protectionism and economic uncertainty. So we need FDI because it's driven growth, introduce new technologies, build industry, and creates jobs. What the tariff problem? The tariff, which is the import taxes, make production more expensive and lower profits because investors need stability. This extra cost scares them away from long-term projects. So the impact of the investment decline can be poorest countries suffer the most. They rely on foreign money for infrastructure, jobs, and technologies. Without it, the gap between the rich and poor nations will be get wider. So there are four key factors contributing to the decline. The first one is increased tariff and trade barriers. High trade costs restrict market access, reduce expected returns, and lead to the delay of cancellation of cross-border investment. Second is geopolitical tension. Events like US and China economic dispute and the Russian-Ukraine war disrupted the global supply network, which is a hurt investor confidence and forced companies to shift investment to the lower risk region. The third one is policy uncertainty. Unstable or changing the government regulation, taxes, trade rules, and monetary policies increase the corporate risk. Investors strongly prefer countries with stable and predictable regulatory environments. Fourth, which is the last one, is the supply chain problem. It will go a labor shortage, logistical constraint, and geopolitical conflict, create manufacturing delays, and spike logistic costs. Consequently, multinational corporations are scaling back global expansion in favor of regional operation or nearshoring. Thank you.
Thank you, Shahida, for the previous part. Assalamualaikum. I am Siti NORATIEKA binti ABDULLAH, and now I will explain the critical impacts of a global economic growth slowdown on foreign direct investment, or FDI. As shown in the infographic, a healthy FDI ecosystem is crucial because it brings capital injection, technology transfer, and global market access. However, according to the UNCTAD report, the outlook is turning negative, causing a serious decline in the investment sector and limited economic activity worldwide. This economic slowdown directly damaged four key areas of our society. First, in manufacturing, factories face major production slowdowns due to lack of capital and demand. Second, the technology sector suffers from reduced R&D funding, which unfortunately stalls global innovation. Third, the energy sector experiences a slower transition to clean and renewable sources because green projects lose their financial support. Lastly, service industries are hit hard, leading to less capital for business expansion and ultimately lower job opportunities for the public. A drop in FDI is a serious chain reaction that slows down industrial progress, stops innovation, delays green energy, and reduces employment globally. Moving on to the next slide, the core focus is job losses and reduced infrastructure development. I will explain where the investment is actually going and the problem of misaligned investment. As we can see, despite having stable capital inflows into developing nations, the main issue is that this money is going outside the primary job-creating sectors, flowing into non-specific industries and simple commerce with stagnant effects. Sadly, our critical sectors like energy, infrastructure, and technology are lacking the investment they desperately need to boost productivity and long-term growth. Because the money is going to the wrong place, it creates a story of misaligned investment that leads to job losses and reduced infrastructure development. The final result of this mismatch is twofold. The first one is we can see the stagnant growth with low employment opportunities and limited skilled jobs. And the second is we face a major lack of proper infrastructure resulting in incomplete bridges, old power systems, and obstacles for overall progress. Okay, now let's take a look at the risk of a worsening investment cycle, which acts like a dangerous loop. According to the OECD report, low transaction and project activity in recent times indicates a longer-term downward trend rather than a temporary phase. This infographic clearly shows how the crisis fits into itself. Declining levels of investment lead directly to lower levels of economic growth marked by slow-moving businesses and dropping GDP. This economic downturn creates greater levels of uncertainty and makes investors highly cautious. As a result, we end up with even lower levels of investment and fewer resources allocated to development. The key takeaway here is the banner in the middle. Okay, as we can see, the cycle becomes increasingly difficult to reverse the longer it continues, trapping economies in a negative downward spiral. Moving to the next point, which is widening regional inequality. This table highlights a stark contrast in FDI performance across the globe in 2024. We are seeing a very unbalanced world right now. On one end, Europe experienced a dramatic plunge of 58%, and Latin America also saw a 12% decline. However, on the other end, North America is surging with a 23% increase. Most importantly for us, Southeast Asia remains a strong and attractive destination, growing by 10% and successfully bringing in $225 billion. This data proves that investment is not flowing equally. While some regions are advancing rapidly, others are struggling significantly, creating a dangerous gap in global economic development. And the last one will be the distort investment data and policy making risks. At first glance, the headline figure from UNCTAD shows a positive FDI growth of plus 4%, reaching $1.5 trillion. However, this is an assessment problem caused by conduit economies and financial distortions. When dollars just flow through these transfer points without any real productive investment, it distorts the real figures. If we look at the underlying reality and strip out these conduits, the actual UNCTAD data reveals an 11% decline, marking the second consecutive year of a downward trend. This distortion creates dangerous policy making risks. Policymakers who rely blindly on the superficial plus 4% headline are misled into believing there is global growth. Because they miss the sharp downward trend, the consequences are severe, leading to ineffective economic policies that fail to address the real decline. That is all from me. Now I pass to Liana for the next part.
Thank you, Nora, for the great explanation. Now I will continue with solutions and actions. My name is NADZIRAH binti Muhammad Isa. So one of the best ways to encourage global investment is by creating a stable and predictable trade environment. So investors are more willing to invest in a country when government policies are clear, consistent and transparent. However, frequent changes in tariff and trade rules create uncertainty. This makes businesses less confident about expanding into new markets or making long-term investment. So to solve this problem, governments should work together through international trade agreements and negotiations. They should reduce unnecessary trade barriers and resolve trade disputes peacefully. So this cooperation helps create a more stable global market and improve investor confidence. So when businesses feel confident about future trade policies, they are more likely to build new facilities, expand their operations, and create more job opportunities. So in the long run, stable trade policies support economic growth and benefit both developed and developing countries. The second solution is to improve the investment climate. So government should create a business-friendly environment to attract both domestic and also foreign investors. So this can be done by offering investment incentives such as tax break, reducing unnecessary bureaucracy, simplifying business registration, and making regulation clear and consistent. So it's also important to maintain political stability and provide strong legal protection for investors. Because when businesses know that the law are transparent and their investments are protected, they will feel more confident to invest. Next, government also should encourage investment in growing industry such as digital technology, advanced manufacturing, and renewable energy. The third solution is to invest in infrastructure and future industry. The article states that investment has declined, especially in industries that are important for long-term economic growth. To address this issue, government should continue investing in infrastructure, renewable energy, and digital transformation. Good transport system, renewable energy, and strong digital infrastructure help businesses operate more efficiently and compete in the global market. Government should also work together with private companies through the Public-Private Partnership or PPPs. This partnership also help to reduce government spending while allowing private companies to provide their expertise, technology, and innovation. The fourth solution is to strengthen international cooperations. So the investment challenges we face today are global, so no country can solve them alone. So countries need to work together to overcome these challenges. International organizations such as UNCTAD, the IMF, and the World Bank can support countries by providing policy advice, financial assistance, and technical expertise. Government should also strengthen regional trade agreements and encourage cross-border investment partnerships. So this can help reduce the impact of trade conflicts and geopolitical tension. By working together, countries can create a more stable and resilient global economy. It also allows developing countries to join global supply chains and attract more long-term foreign investment. The final solution is to encourage sustainable investment. As the global economy continues to grow, sustainable investment has become more important than ever. Government should encourage businesses to invest in environmentally friendly industry by providing incentive for renewable energy, green technology, and sustainable infrastructure projects. Financial institutions can also support this effort by offering green financing options such as green bond and sustainability-linked loans. Sustainable investment not only protects the environment but also creates new industry, generates more job opportunities, and strengthens the economy in the long term. Companies that follow environmental, social, and governance or ESG practices are more likely to attract international investors because many investors now consider sustainability when making investment decisions.
Hi, this slide is about critical analysis on strengths and weaknesses for this article. In strengths, it will have a high trust and relevance because we are using the incredible sources, which is used data from Reuters and as the world's largest news provider, and UNCTAD, which is the UN body tracking global investment. Also, this article is a data-driven, which is we rely on the recent forecasts and facts rather than opinion. The target audience, which is a highly relevant for policymaker, corporate leader, and finance students, just like us. And then next, the weakness for this article is about broad scope and omission, which is it is too general because it is offer a global overview but lack regional analysis such as how tariff affects Southern Asia vs the US or Germany differently. Also, they have a missing key factor which is focuses too heavily on the tariff while ignoring other major investment risks such as climate change risks, tech transformations, demographic shift, and rising interest rates. Okay, next we move to our opinion about this article. FDI is weakening the trend, which is the global foreign direct investment FDI fell by about 11% in 2024, lagging behind general GDP and trade growth. So, as rising tariff, geopolitical tension, policy uncertainty, and inflation, what the impact? The higher trade barriers raise manufacturing costs and disrupt supply chains, and causing multinational corporations to delay long-term investments. What the strategy recommendation for the government? She focused from trade protection to international cooperation and stable, predictable policies. For the companies, diversify portfolios outside of established area into emerging nations such as Southeast Asia, Latin America, and Africa, as to reduce geopolitical risks. Supply chain shifting. Use strategy like China plus one, nearshoring and friendshoring to stay competitive. Also need to focus on the new investment opportunities, which is future sustainability. Global investment are expected to target fast-growing sector, including the digital technologies and AI renewable energy. Also, green investment, sustainability infrastructure. That's all for me. Thank you.
Assalamualaikum and good day everyone. My name is HIDAYAH NAJWA binti HAIRUL SALEHUDDIN. Today, I will be presenting the application of international finance and investment theories based on the article titled Global Investment Decline May Worsen Due to Tariff, UN Trade Agency Warns. The first theory that relates to the article is the risk-return trade-off from Chapter 3. This theory states that investors are willing to take higher risk only if they expect higher returns. However, when uncertainty becomes too great, investors become more risk-averse. In this case, the increase in tariffs and trade tension has made international investment much riskier. Although investing overseas may still generate good returns, many multinational companies prefer to postpone or reduce their investment because the risk outweighs the potential benefits. As a result, global foreign direct investment continues to decline and international business expansion slow down. The second concept is financial market and the flow funds, which is also from Chapter 3. Financial market play an important role by transferring funds from investors to businesses that need capital for expansion and development. When investors become more cautious, international capital flows decrease. This means businesses receive less funding to build factories, invest in technology, improve infrastructure, or expand into new markets. Consequently, fewer productive investments are made, which slows overall economic growth. The third concept is financial globalization and availability of capital from Chapter 7. Normally, globalization allows multinational companies to access funding from international financial markets at lower cost. However, the article highlights that rising trade barriers and policy uncertainty are reducing cross-border investment activities. As global capital becomes less mobile, companies face higher financing costs, have fewer opportunities to obtain funding. Because of this, many firms delay large investment projects until market conditions become more stable. Well, in conclusions, the article clearly demonstrates how rising tariffs and global uncertainty negatively affect international investment decisions. By applying the risk-return trade-off, financial market and flow funds, and financial globalization and availability of capital, we can understand that when investor confidence declines, international capital flows become weaker, foreign direct investment decreases, and global economic growth slows. That's all from me. Thank you.
Lastly, I would like to conclude our presentation. Global foreign direct investment continues to decline because of rising tariff, geopolitical tensions, and policy uncertainty. As a result, many companies are becoming more cautious about investing in other countries. This decline can slow economic growth, reduce job opportunity, affect infrastructure and technology development, especially in developing countries. To improve the situation, government should promote stable trade policies, strengthen international cooperation, improve the investment climate, and encourage sustainable investment. Overall, a stable and cooperative global investment environment is important to restore investor confidence and support long-term economic growth. Thank you.